Fools, dividend investing has never been more popular as investors really look for that combination of current income from their portfolio and the potential for growth down the road. But there are a lot of things that people don't know about dividend investing. My name's Dan Caplinger. I'm the Motley Fool's Director of Investment Planning, and today I want to take a look at 3 things that you didn't know about dividend investing. Now, one thing that beginning investors often make the mistake of is thinking that dividend yields automatically correlate to the amount of money that a company is making in profits. And that is definitely not the case. Often you see different companies making different decisions about how much of their earnings they pay out as dividends. For instance, real estate investment trust Annaly Capital, Master Limited Partnership Kinder Morgan, both of those entities are required by law to pay out a substantial majority of the amount that they earn in dividends distributions to their investors. And so you will usually see a strong correlation between earnings and the amount that they'll pay in dividends. Now, on the other hand, you have some stocks that pay only a small fraction of their profits in dividends. Companies like Freeport-McMoRan, ConocoPhillips, they've enjoyed huge earnings in recent years, but they've only paid a small amount in dividends, even though their dividend yields are relatively attractive. And so you have to look beneath the surface to see whether a stock has the capacity to keep making those dividend payments in the future. Now, second, in some cases, dividend growth can actually be a better indicator of long-term success than current dividend yields. Oftentimes, when you have a high dividend yielding stock, that dividend proves to be unsustainable. And so you see both income fall and share prices drop when the company decides it can't pay that dividend anymore. On the other hand, when you have long-term payers that have raised their dividends year in and year out, eventually you get to the point where the income that you generate is really a lot bigger than it was when you first bought the stock, and that can be very attractive. Now, third and finally, when a stock pays a special dividend, you often see strange reactions to it. For instance, a lot of the time, what you'll find is that the stock price moves up by the amount of that special dividend. Now, be careful when that happens because dividends don't create money out of nothing. When a company pays a special dividend out, it reduces the amount of cash it has on hand, thereby reducing the intrinsic value of the company by the amount that it pays out. And so these big jumps following special dividends often make little sense and definitely aren't worth seeing as a big buying opportunity after the bump happens. Now, for more on dividend stocks, be sure to stay tuned to Fool.com for more information. Thanks for watching, and Fool on.